This podcast is intended and contains general information on financial strategies, investments and products only. Whilst Luke and I are both licensed financial advisors, we don't know your personal circumstances, goals or objectives. We highly recommend that you reach out to your financial advisor or investment professional to discuss any of the topics that we've covered today before taking any action. Our full disclosure, copies of our financial services guide and additional information about Seneca Financial Solutions and Bold Wealth can be found in the show notes.
Hello and welcome to another episode of Wealth and Toil. My name's Luke Laretive. I'm from Seneca Financial Solutions and I'm here today with the man, the mystery, the Mayor of Hobart, Dylan Pargiter-Green, DPG. How are you, mate?
I'm very well, mate. Not sure about Mayor of Hobart, but Mayor of Bold Wealth, perhaps.
Yeah, well, we'd hope that. We'd hope for that at least.
We'd hope that. Mate, how are you? Last episode for the year.
Last episode for the year, thank the Lord. I mean, I'm really happy to be here. No, I'm okay. I've been a bit sick this week. I've got the man flu, so yep, just been trying to shake that off. But I'm on the back end of that now. So otherwise, just trying to bang out the rest of the year really, and get to the 20th. And I'm going to take 2 or 3 weeks off. And
you won't actually be off though, because the markets never stop, mate. They never close.
The money never sleeps. No, I'm taking time off. So the
all
money never
must be processed by 3 p.m. 20th of December.
Money never sleeps, but I do. So I will be off, but we'll have cover as always. But what about you, mate? What are your plans over the next few weeks?
So we have last week of meetings this week, or finish on Monday actually, and then we've got a few admin days next week. We do a big admin tidy up, finish the year, and same as you, finish officially on next Friday, and then sleep. I reckon sleep is on the cards.
Good idea. Really good idea.
All the family Christmas stuff. Everyone in my family seems to be born in December. So, my brother-in-law, me, my dad, bloody cousins, Jesus, all the people, all the important people that were born in December. So, lots of birthdays, lots of celebrating. Might have a prawn or two, and
very good. Yeah, very
back
good.
in Jan. So, we thought we'd do. I think we're doing a bit of a fun episode. Something that I like to talk about a lot.
Something I've got no interest in.
Well,
it's pretty much that's how most of our episodes go, isn't it? It's either something you like or something I like.
Yeah,
we don't have much crossover.
One day we will find something that we both enjoy.
Common ground. So we're going to talk about Big Super. Is that what we're going to talk about today? Big Super.
Yeah, I think you'll find you actually do have some interest in this.
No, I do. I'm just being facetious as per usual. So, Dil, we've got a few issues in Big Super at the moment. Maybe do you want to Do you want to enlighten the punters about what is happening with their industry super funds?
Yeah, so when we talk Big Super, we're talking about the largest superannuation funds in the country. And
so can we rattle them off just quickly? So there's
I'll get there.
CBUS.
Yeah, so over the last 20 years, there's been a big transition into industry super funds and 4-member funds, and they've done a lot of really wonderful things, and that they still do for a lot of younger starting off people. They're wonderful options. But more recently, I think there's been a fairly significant light shone on the lack of planning that they've got, and that's why we're seeing them on the back and front of the AFR pretty much every second day, with new problems arising within these. So it's fascinating, because some of the problems that we saw in the 2010s, where your Commonwealth banks and like your colonial first states and your AMPs and your MLCs, they had, the biggest retail superannuation funds, and that volume of money is very challenging for one organisation to manage effectively. And so what we had is some, internal issues with both investment and also, administration of those, and that then got
governance.
Governance.
Poor governance is the word you're looking for there.
Poor governance. Off the back of that, industry super had a real boon, and again, it's like industry, retail, wrap, like whatever it is, doesn't really matter. But big super had a big windfall, and that was, they were able to sort of take advantage through advertising of what they called the Fox in the Henhouse advertising campaign, where they effectively made it look as though your traditional superannuation funds that had been around previously and traditional investors were not out to give you the best bang for your buck. What we then had was this large amount of money that went into these funds, to the point now where right now we have the sort of 5 biggest superannuation funds, all with greater market influence than the 2 largest and longest standing financial institutions in Australia did from the 60s to the 90s, and they are AMP and MLC. AMP has a very tainted recent history as well, and MLC recently decoupled from NAB, or a few years ago decoupled from NAB, or the National Australia Bank, and basically separated themselves. So what's going on with Big Super is that they're facing challenges and hurdles that they haven't had to do so before, and it seems to be that there's cracks showing in the organisations, both from a governance point of view, and I think that's what Luke, likes to smile at me about, because
governance is important, and it is boring. It's like compliance. It's like lots of things. It's like safety. It's very boring stuff. No one's very excited about it. No one makes a lot of money out of it. But if you don't do it properly, people die. People's life savings get blown up by BBY or crooks, and we end up with problems at the tax department, or these sort of issues. So it's all good until it's not, and that's why I just think we need more focus on these boring things. They're very important.
Yeah. So, I mean, look, there's countless articles that can be referred to, but certainly the AFR have had a big run of them. I think the most worrying thing, and this is probably where we'll talk about the investment side of things, is what this podcast is mostly about. But the most worrying part is that, it's the superannuation sector is on track to be bigger than the banking sector, which effectively means that, over the next sort of 10, 20, 30 years, the growth in income that's coming in from your superannuation contributions accumulatively across the population of Australia is going to be worth more than all the money and deposits and loans and things that we have in the banks in Australia. And that's too much. That's probably too much for the little number of managers to be managing across those larger industry superannuation funds.
Can I interrupt you there, Dill?
Yeah.
So the other important thing people need to be aware of is the internalisation of the investment management function at Big Super. So the core business proposition of Australian Super, ART, Australian Retirement Trust, CBUS, insert Host Plus, whatever, forget the other one, but is essentially this. We're going to buy up all these smaller industry super funds, roll them all into us, and instead of paying fund managers, external fund managers to run money for us, we're going to hire fund managers and we're going to run that money ourselves. The issue with that is that you don't get as good a people. It's the same problem I talked about recently on Equity Mates, is that good people want to be in boutiques where they own 100% of the equity, and guess what? I get to make 100% of the money because I'm good, so I wouldn't want to work for someone else and give them a share of the money. Because, surprise, surprise, being a fund manager is actually really well paid. You only got to go through the BRW. As far as I can see, there's only 2 ways to make money in Australia. You're a fund manager or you're a property developer, right? So it's a very lucrative industry, and if you're smart, you don't want to work for Australian Super. I'm not going to work there. I'm just not going to work there. I just wouldn't, because the equity I can build on my own is better. So, from my perspective, the internalisation of the investment management function into these businesses actually breeds mediocrity and actually breeds a lack of competition, because before you could just take money off fund manager A and give it to fund manager B, and that creates competition in the marketplace for these super assets every day, and they would still scrounge us all down, grind everyone into the grindstone for on fees. It wasn't like you were paying more fees, but now it's all internalized. They say it's cheaper. Well, cheaper is not always better, particularly in funds management. So that's the other sort of thing you've got to be considering when we talk about the amalgamation of big super and what's actually happening inside these organisations.
Well, that's it. And I think you've got smaller teams running larger amounts of money. It creates bias as well. So if you think about like a lot of large investment funds will have multiple streams that they're then investing in and multiple areas that they might be putting money in, but they usually have a closure point or a point at which they stop taking on new capital, because it's not possible to run that strategy efficiently with the volume of money that they have under management, right? So we talk about small caps a lot. It's very hard to run a $100 billion small cap fund. Like, it doesn't work, right?
Yeah, but that's not really what they do. I think the issues. Go on.
Leads me to the next point, right? So what has actually happened is we've led to largely index hugging investments. So underlying stock-based investments within those funds are index hugging, if not basically direct indexes. They've got large mandates that probably used to be there with people like Vanguard and State Street and people and things. A lot of the ones that have internalized that now just track the index internally. So that's fine, but you're probably paying 30, 40, 50, 60 basis points for market-based investments that are in index hugging. But because of the volume of money, you can't just throw 50% of Australia's superannuation into an index and not think that it's going to have an effect on that index. Like, this is such a large amount of money, right? It's driving the index itself.
He's walking straight into the trap. Keep going.
No. So there's a restriction, right? There's a restriction on how much money that can be put into these strategies, because that amount of money has a limited capacity in terms of making, individual stock-based decisions, which is why we've.
This, Dylan, is why large caps for the last 12 months or 18 months, part of the reason why are trading on generally insane valuations, and why CBA has gone from 8 to 9 to 10% of the index. It has got nothing to do with CBA's business being good. It's got everything to do with the weight of money allocating on the basis of index weight.
It wasn't because CBA were going to charge $3 for ATM fees. That wasn't going to be the difference for them.
I've never used an ATM in ages, so I think but I don't. All I'm trying to say here is these weights of money create. Just if everybody's index investing, they create distortions. Now, when do those distortions get rectified? I don't know. Well, I'll guarantee you they get rectified. So it's going to be very interesting. It's going to be really interesting. Is allocating your money on a market cap weighted basis the best way to deploy capital ad infinitum forever in perpetuity? I don't agree. I don't think it is. Now, we'll see. Maybe I'm wrong. But I think that these weights of money you're talking about do create distortions, and the things that are happening inside industry super, including the indexation of everything, and internalizing of investment functionality, and the type of people that end up working in these sorts of organisations result in a skew, a bias, whatever you want to call it. And it's a bias that I don't really want any exposure to.
Yeah, I mean, I think the sort of flow on of that index and the inability to really run like a market-based strategy is that we've seen, industry super, and this has been talked about a lot recently, but industry super go and buy a lot of unlisted and private assets which don't have the same reporting requirements as publicly listed traded assets. So we've seen investments in a lot of private infrastructure. There's been investments in large companies like Canva, which has been widely valued in the media, and then very widely valued by different funds, to the point
this
where
is all. Yeah, but do you really care about? Why should I care about private investments? Why do I care about if they get priced this quarter, or next quarter, or next half, or in a year's time? Why is that relevant to people?
Well, because it's relevant because of liquidity, right? So these private assets do not have the same liquidity as tradable assets, and we are about to enter a period where another 3 million people of the current, another 50% of what the current people in retirement drawdown are going to exist in that phase in the next 10 years. So basically, we're going to have a 50% increase in the people who are taking from superannuation, and not a 50% increase in the amount of money that's going into superannuation. So it's a problem to hold these unlisted, illiquid assets and it's more of a problem when we're potentially overvaluing them during times of market downfall, and then making those corrections over the subsequent years. It's not it's being called not an appropriate use of the average punter's money.
I'm going to call my issue with it is the following: whether you are a private credit fund, a private equity fund, a private whatever real estate fund, whatever, doesn't make a difference. And whatever Aussie super or infrastructure, whatever they want to invest in, I don't really mind. They can pick. That's their job. That's what they get paid to do. They're entitled to make their own investment decisions. However, as a customer, now I am a customer of Australian Super. I have my insurance minimum balance there and insurance, and I manage the rest myself. But the issue I have is when you don't mark to market. And what I mean by mark to market is you take a fair, independent, current market valuation of those assets and report them as part of your returns in the same way that I do. If I've got 10% invested in CBA this month and it goes up or down by 2%, well, that's what I report back to clients every day, every night, every month when we make a report. So I just expect the same standards for private assets as we do public assets. Now, it's fair enough that you can't give me a daily price value of a bridge in San Francisco or wherever the hell you've bought this, this infrastructure asset, right? But it is unreasonable for me to also expect that some consultant you're paying a shitload of money to is going to be independent. Now, we can argue about that opinion till the end of days because it is just an opinion. But I don't think, and I've never seen a valuation come back from a very well-paid consultant that is unfavourable towards the asset owner. So you can take that with a grain of salt.
There's bias.
But I think I think fairly skeptical sometimes of those valuations, particularly say in the recent period when we had interest rates move a lot and the cap rates moved so slowly relative to rates and bond yields, and we had real estate investment trusts that trade on the ASX down 30% on NTA, and we had the assets held in private assets in the same asset classes, in the same cities, in the same type of real estate, marked down 3 and 4%. To me, that just screams bias. So,
I think in that period,
look, I'm not saying this is some sort of conspiracy. All I'm trying to get the point is that sort of level of opaqueness is not where I want to invest my money. I just vote with my feet, right? Like just vote with your feet, and I think it's that simple. And I don't think industry super is a great place to invest money anymore. I think it's been okay. But personally, I think you can do a lot better outside, and I don't think it's a case that the industry super has got access to all these opportunities that you're not going to have access to with a decent advisor who's got half a brain.
Yeah, I mean, as I say, look, it suits some people, and that ride along
Dil,
with the wave. And
can I ask you, is industry super, the fees on there, when I had a look at last, it was about 60 bips. Is that a fair assessment?
It varies quite a lot, and I know we try not to specifically call out product, but there's some fees that are around the sort of 40.
Okay.
But one comparison we did recently, and probably one of the most popular off the back of our good friend Scotty, the Barefoot Investor, was Host Plus. They're
your good friend. Yeah, go on.
Core growth option now is over 1% as a baseline fee. So that's
to me, I'm not paying somebody 1% to speak to a call center, just from a service perspective. Forget about the investments. No. I just wouldn't do that. I'd pay me 1%. You get to speak to Victoria, and Larissa.
You get to speak to Victoria and Larissa. No,
you're not speaking to me. Yeah. Clients that actually get to talk to me. I'm joking. So I would think that is
it varies.
Price what you pay, value is what you get. That's bad value, in my opinion. That's bad value.
And I think, look, the advice is probably always what we say, which is actually look into what you've got. The devil is in the detail with a lot of these things. Look into how the unit price is changing, what the cost of your specific option is. Don't just look on, compare your super or whatever it is. Actually go into the detail on the PDS and have a look through it. And
let's face it, no one's doing that. No one's doing that.
Well, if you're that interested, you can. And
you should, but you
want.
Won't.
If you really want to get an understanding of where your superannuation is at, you can speak to an advisor and get an understanding of maybe where it's tracking, what it's done over the last few years, transparently, and get some real life comparisons, and then you can choose to stay or choose to move. But at the end of the day, I think what Luke said is really important, and transparency, right? Like I believe in it, knowing what you're owning and how it's tracking live, and having confidence that there's not some dark curtain that's going to be pulled aside with all these assets that have been overvalued just so that you can effectively advertise a higher rate on the television.
It's pretty shit.
It's not for me.
Hey, Dill, can you just remind me? Can you please do my insurance, or review my insurance?
Yeah, for sure. If it's with Australian Super, we should probably talk about that.
I never change it. Editors, please keep this in. I'm not trying to be funny here, but it's actually quite interesting. Say for me, I don't think about my life insurance and stuff that often, but I did set it up through Aussie Super before I had the superannuation products, and before I didn't want to have a self-managed, so I just had Aussie Super High Growth, and then now I've got a super product. I rolled all the money out of there, but I left a minimum balance, and every probably 6 months I just log in and I just roll whatever's on top of that minimum balance out.
Whatever you need,
and I've just left the insurance thing there. But I probably could get a better deal or same cover.
You could get better cover, more likely.
For the same price.
For the same price, or maybe cheaper.
Okay, good to know. I mean, I'm not an insurance guru, so I don't know anything about this stuff. But okay, so I'll get you to do that for me.
No worries.
What else did you want to cover?
Should we do it now in this episode? We'll go through.
I could do screen share and log in, but I'll refrain. Anything else you want to have a chat about today, matey? Apart from slagging off industry super for an hour and a half.
No, look, slagging off industry super for half an hour, I think is good. It's a nice way to end. I think, look, we're one point to make at the end of this, and then I think we've got a fun question to finish. But one point to end this is we're not picking on it for no reason. It's been in the news a lot recently, and for good reason, right? Like, it is actually a worrying sector, regardless of whether this is an industry super or if it was retail funds that were getting this big. There shouldn't be that much, in my opinion. They're getting sort of to that point where we have too much money in too few people's hands, and I think that it's going to be a big thing that plays out over the next few years, and it's going to be really interesting to watch. So,
look, our business is built on the principle of courageous transparency, and what we mean by that is we want to be able to speak to our clients frankly, openly, and be able to explain in a really clear, simple way every decision that we make. Now, most clients don't ask me about every decision that I make, but I think that having that level of transparency on your portfolio is actually very empowering. Forget about useful, but just it's actually quite empowering. And
I think one of the things that always gets me is that, like, I don't see a reason why they don't report the numbers more, like the asset values more frequently. Like they could.
I've got a few ideas, but we might.
Yeah, well, that's the thing. That's the thing. Right?
Conversation over a beer, but I think,
why not? If there's nothing to hide. What? I don't know.
I don't know. We're probably going to get sued.
I hope this podcast doesn't end up with a suit. We look forward to receiving a nasty letter in the mail from.
Please send it care of Dylan Pargiter-Green at Bold Wealth. I'm just a guest. Dill. All right. Look, let's wrap it up for the year. Mate, did you want to do something fun at the end? Is there something you had in mind?
Yeah, come on. It's Christmas. It's Christmas time. It's the holiday season.
Yeah,
right?
yeah.
All I want for Christmas, is something for 2025. What do you reckon?
What do you mean something?
Well, what do you want for Christmas? Could be something for the business for 2025. Could be something that you're going to get as a gift.
$100 million in inflows and a takeover offer for Seneca, so I can retire.
Okay, nice. Yep, very good.
Yeah, that'd be nice. No, what do I want for Christmas? I think this year, I just want to keep doing exactly. I want to keep growing and doing exactly what I've done for the last 12 months. Finally, after 7 years of running this bloody business, I've got all the product I need. I've got all the people I need. We're doing the exactly what I think we should be doing, and I just need to do more of it. So
probably too many podcasts, but
I would suspect Wealth and Toil is going to get a haircut, but that's a story for another day. Just
a trim,
because it's taking up too much of my time. But I do think that it is for me, everything's going well at the moment, which is something I couldn't have said 2 years ago. And if nothing changes, Australian Super don't sue me, and we can just keep growing the way we've been growing, I'll be wrapped, and I'll look forward to retiring in 2027.
Yeah, very nice. 2027. Call it 2026, mate. Just call it early.
Nah, look, I'm joking, but it has been a good year for us, and I mean, we've got kick-ass numbers. I think if I had to make a prediction, I think 2025 will be the year of the large cap SMA. And at the end of next year, everyone will be like, well, I wish I had more money in large cap. Hasn't had a great year this year, last 12 months, probably underperformed a bit. But I've just been doing this long enough. I know how this shit goes. So it's the oracle. So that's my prediction for the year. What about you, Dill? What do you want? What do you want for Bold next year? Forget about Christmas, because I know you're not a religious soul, unlike me, who goes to church every Saturday.
Yeah, on a Saturday you go before the crowds, do you?
just shows you that I don't go to church. But yeah, that's yeah. Go on. Yeah. Anyway, talk to me.
Look, I think it's a really nice sentiment. I'm going to steal that and say, if we did the same sort of stuff that we did this year, the amount of new people that we've been able to bring on and help and sort of see, through the stuff that we're doing,
That's a unique concept of actually helping your clients. That's pretty unique.
Yeah, well, it's not so unique, mate. It's something you might come around to one day. But no, it's been awesome. We've done a whole bunch of new stuff. Big shout out to Equity Mates who had us both on throughout the year. That's been really good. And yeah, I mean, we're in the process of looking at hiring an advisor, which would be fantastic. We may end up with 2 by the end of the year. Probably a new office space down in Hobart, which is also going to be great. So yeah, and then
sounds like overheads that'd take away from my profits. So I'm not really interested in either of those things.
Well, we're also probably going to move out to a different office space from our Q office as well. So for all those people who are like us and have a lease that's from 2019 pre-COVID levels, you will feel that pain. So no, we're looking forward to having a bit of new space, bit of new spritz, few fun client things planned for next year, but I won't say what they are.
Exciting.
Yeah, might even get some of the clients introduced to Luke if he can bloody hold his tongue.
No, we don't
say some nice things every
pretend
now
like I'm nice to people. I'm good at pretending. All right, mate.
Economic updates only, mate. But
yes, we'll be doing that. Plenty of that sort of thing going around. No, that's great, mate. Look, I've had as much as I whinge about it, it's actually always fun doing this with you when I get into it. And we've had a good little run. I'm pretty proud of our consistency. Well, I wouldn't call it quite consistency, but it's pretty good.
It's been pretty good. I think. So for everyone that's listening, like Equity Mates produce our podcast for us. We don't sit and edit the sound and do all that up until the end of the night. So we have a wonderful team of people. We've got Clay. Shout out to Clay for posting it all
Clayton
for us.
Smith from Smith Social in Perth, my good friend. He's getting. I'm actually going to his wedding on the over Christmas New Year in Perth. So
very nice.
It should be very nice for the great long-haired assassin in Perth.
Yeah, get him on the gram. But no, shout out to everyone that's helped, everyone that's been on the podcast. It's been really fun. And yeah, I mean, like Luke said, we aim to continue doing this all throughout next year as well. Whether or not we might strip back and
just a frack.
Do a few a month rather than 5 a month or 4 a month. We'll see. We're going to do a bit of a calendar. But to anyone that has actually listened, I know we joke that there's only 7 of you, but to anyone that's listened and enjoyed, thank you. And bloody have a great Chrissy holiday season, however you want to celebrate. And we'll see you next year.
Yep, only echo those sentiments, mate. Been a pleasure. I'll look forward to a break and getting back into it with you in the new year.
Always a pleasure, mate. Never a chore. Merry Christmas.
Merry Christmas, bro. Chat soon.
See ya, mate.
Bye.